Hello guys and welcome to another video. My name's Mark, I'm an entrepreneur and property investor, and in today's video, in under 10 minutes, I'm going to try and explain a very complicated subject, bridging finance, to you. Now remember that I'm not a mortgage broker and I'm not qualified to give you advice in this area, but what I do have is a wealth of experience. I've done bridging on I think 3 or 4 of my projects, so I've got some good experience, I've got some good first-hand knowledge, I've also got some great contacts in the industry who I can call on who've given me some more extra information. So today we're going to talk about bridging finance. Let's get into the whiteboard and let's go through exactly how it can help you supercharge your property investing journey. Let's go, guys. So guys, welcome to the whiteboard. We're going to be going through bridging finance. I'm just going to take my sunglasses off. It's so bright outside today, so I don't need them in here. Bridging finance, let's get stuck into it. And if you haven't already liked and subscribed, please consider subscribing. Give this video a like, it helps me out with the algorithm. Remember, every month we give away the dividends from the dividend portfolio, so you can get cash every month. And on top of that, eventually we're going to be giving away an investment house. So great reasons to subscribe along with all this great information. So let's get into bridging finance, how I use it, what it is, all that sort of stuff. So first of all, what is bridging finance? Now, bridging finance is slightly different to mortgages in the way that it's set up. It's a very short-term loan, normally for a term of 12, maybe 18 months, but generally 12 months. And it's to bridge a gap in funding. Thus the name, bridging finance. So if I amalgamate this point into why bridge, like why would we use bridging, I can start to give the reasons and loop that back to what it is. So a reason that we might use bridging finance is auction properties, where we have to complete quickly. And bridging finance is unregulated, it's short term, and because of that, it can be done quite quickly. The whole essence of bridging finance is that it allows you to draw down funds quickly on properties that you wouldn't be able to get a mortgage in that timescale, or would just be unmortgageable in general. So auctions is a great place to use bridging finance. Another thing would be if you can't get a mortgage on a property. So I did a property in Wellingborough, which was unmortgageable. They wouldn't give me a mortgage. I did attempt to get a mortgage on it, and they said it was not in a good enough state of repair for it to be mortgageable. So I took out a bridging loan. I then did the renovations. I then switched it onto a mortgage product about 6-8 months later, something like that. And at that point, I was able to release some additional funds into my bank account and essentially refinance money back out of the property, both my renovation costs and some of the margin of what I made. So bridging finance is really a short-term loan to bridge an issue that you may have. And issues include things like auction properties where you need to complete within 28 days, unmortgageable properties where, let's say for example, Japanese knotweed would be a great example of a property that's unmortgageable, a property without a kitchen, a bathroom, something that somebody couldn't move into. They would all be classed as unmortgageable, and if you tried to get a mortgage, the valuer is going to come out and say, actually, this isn't habitable, we can't rent this out, we can't see any demand for property in this state. So that's why we would use bridge, and that's what it is. So in terms of what sort of rates you can expect and how much it's going to cost you, because I think that's quite an important thing. And remember, again, I'm not a mortgage broker, but what I have got is a bit of experience and a lot of contacts and people that I have been speaking to. So I know at 50% LTV, you can get around about 0.5%, and that's per month, so that's 6% per year. At about 75%, I think I last borrowed at somewhere like 0.69. Or 0.65, I can't remember exactly. And on each of the 3 occasions that I've borrowed at around 75% LTV at about 0.65, 0.69 per calendar month. On top of that, I've also been aware that there's 80% bridge loans available with additional drawdowns for doing renovations and things like that. They generally run about 1%, maybe slightly more if you're going to draw down additional funds on top. But these aren't the only fees when it comes to bridging loans. They are quite expensive. Generally, you're going to pay for their legals, your legals, you're going to pay for a broker charge, you're going to pay for a valuer. There are a lot of fees rolled in with bridging loans, which is why they can be quite expensive. When you're looking at deals to use bridging loans, what I've learned is there's got to be a lot of fat in the deal. There's got to be an awful lot of wiggle room, because the minimum you're going to pay, I would say, is somewhere between 6 and 8K on sort of a 100K loan. It's going to get you the fees, the interest for the first 6 months, and you would aim to exit that bridge within a 6-month period. I just thought another reason you might use a bridge, and somebody I know is doing this at the moment, is on a property that falls below the minimum mortgage value. So a lot of the lenders, the minimum mortgage value is probably somewhere between 50 and 75k. I know the majority are now hitting 75, 100k as their minimum. There are still some that do 50. I think TMW, if I remember rightly, still does a 50k buy-to-let mortgage. But, and again, I'm not a broker, I just have a bit of knowledge in this area. I do keep my eye on the market. But you might buy something for 30k, for example, which would be impossible to get a mortgage on, with the intention of doing work to bring its value up to 60,000. And in that instance, a bridge would allow you to do that. But remember, again, there's got to be so much fat in the deal because you're looking at 6 to 8k fees, maybe slightly less if you've got such a small loan, but still you've got the legal fees which don't change that much. You've got the arrangement fees, you've got the broker fees, you've got the valuation fees. There's quite a lot that goes into it. I can't see you doing a bridge for less than 4 or 5k, even with plain sailing and all the wind behind you. So I would say that there's got to be a lot of money in the deal. Generally speaking, you want to make sure that there's at least sort of 30, 40,000 pounds worth of profit on a 200 grand deal to warrant this additional cost and all the additional risks that come with it. So what are the risks? I know some people say because it's unregulated, then that's a bit of a worry, but unregulated loans apply to all buy-to-let loans almost because they're not on your primary residence. So if you have a look onto Google, you'll find out that most buy-to-let mortgages are in fact unregulated. And all unregulated really means is it's not governed by the FCA. They still are governed by UK law. There's still a lot of protections in place, but they're not governed by the FCA. So you should probably be a little bit more careful and make sure you go with a reputable lender when you're doing unregulated loans. That said, there are some risks. For example, if you couldn't get off your exit. Let's say, for example, you borrowed a fairly large amount of money with an end value in mind, then you could definitely get into trouble if, for example, the project either gets pushed back, if the end value doesn't reach the expectations that you had. And let's run an example of when this could happen and what sort of risk you could be under. So we'll do a fictional project. We're going to buy something for 500k. We're going to use a bridging loan in order to fund the build costs of 300k. And we are going to end up with an end value of 1 million. 200k profit. Now, I appreciate this is very simplistic, absolutely very simplistic. But what I want to do is just highlight how you can get into trouble with something like this should the market not work in your favour. So let's say, for example, you bought the property for 500k, you're going to spend your 300k. Let's say, for example, in this instance, you've got, I don't know, 600k, something like that on bridging finance. So 600k on bridging and development finance, and it's running at 1% per month. So that's 6k every month. So over the course of 12 months, that would be 72k. Using quick maths, I hope I haven't got that wrong. I don't think I have, 72k. So every year that the project went on would lose you 72k. Now, let's say, for example, you get a main contractor, they start the work, but for whatever reason, it doesn't work out. Let's say the contractor goes bust, or they're not doing the work to a high enough standard, whatever reason, it doesn't work out. Now, in that instance, it might take you another 6 months to get another main contractor to start. During that 6 months, let's say that building prices go up and the new quote is actually 360k. So now there's only 140k left in the deal. And we've now gone over budget in terms of time significantly. This is when deals start eroding and margins start going and people can get in trouble. I know of a couple of people who've actually got into significant trouble on projects whereby this has been a little bit wrong, i.e. the build cost. The end value has then come in a little bit shy. Let's say, for example, it doesn't come in massively shy, but just 10%, and 10% on a 200 grand property is only 20 grand. I mean, only 20 grand, it's still a lot, but it comes in 10% short. Now, if you get yourself into that position, you can see that very quickly, you might not be able to exit this bridge in a very suitable way. And you can get trapped paying a huge amount of interest and a huge amount of fees for far too long, and it can completely destroy a deal. So there are significant risks because this is expensive borrowing. On the flip side, there are significant rewards, right? Like if we did this project and it all came out well and we got a 200k profit only deploying, what in this instance, only deploying, and we're only going to have used, in this instance, because we borrowed 600k, we're going to only have used 200k of our own money, which is absolutely phenomenal in terms of return. That's over 50% in a 12-month period. So there are significant rewards, but with reward comes risk, and it's important we always discuss that. And anybody who knows my channel will know that I always say that risk and reward come hand in hand. Capitalism makes sure it's that way. So that's just a good example of a deal that could go badly or well. And it's really important that you're falling on the right side of this when you're doing bridging finance, because they can be notoriously hard to exit if you haven't got your end value right or your build costs right, if something goes awry. That said, if you're doing a project of this sort of size, I would suggest you had significant wealth anyway, because ultimately you don't want to be all in on a project like that. So let's flip back, let's go back to where we were. Okay, so the last thing I think we'll do is we'll just talk about a couple of the times that I've used bridging finance. So I used bridging finance in Corby. I purchased the house for 116. The renovation, I think, came in at 30, and remember, this is just me off the top of my head, I think it was 34. It might have been 35 or something like that. But let's say 34K to make it nice and easy. 150K. I then had bridging fees of 6K. I then had all the rest of the fees, let's say 4K. I got it revalued at 200K. So I made a 40K profit, and I only deployed, I think it was something like 67K, something like that, 70K. So again, in terms of profit to deployed capital, really, really good. I've now refinanced that out. It's looking much, much better. The other one would be the Wellingborough one that I spoke about earlier. That's another great example. Bought it for 126, spent about 35. End value was somewhere in the region of 200. Unfortunately, we refinanced that in the middle of COVID last year, which meant that the end value was only 175. But today, Wellingborough, 3-bedroom, 4-bedroom HMO, nice Victorian terrace. Have a look on Rightmove, 200K is an absolute minimum. So again, nice big profit margin in that, probably made 30, 40K with only deploying maybe 60, 70K of my own capital. So I do appreciate that bridging finance is fantastic used in the right way. I would absolutely urge you to look at it, do your research, speak to a broker, and if you want to reach out to me and speak to me, have a look in the description. There are some links in there, you can get in contact with me. I look forward to seeing you on the next video, and I hope this has been helpful. I'll see you next time, guys. That's been Bridging Finance.